the world is starting to realize the opportunity of nuclear if we really want to hit our emissions targets. It really is the easiest way. And there's new technologies from Bill Gates and others that are much safer, smaller footprint that could change the game. So we're already in that normal destocking bull market. But if you get an actual step change in demand, new reactors being built, then it's a whole different ballgame. This isn't just a normal up and down cycle that can whipsaw you. It could actually have legs.
My name's Max Gagliardi, and this is Always Be Building. If you're watching this video, take a moment, hit the subscribe button on YouTube, or you can follow me on your favorite podcast app. Hope you enjoy the show. Scott, welcome to the podcast. Thanks for coming on.
Max, love what you're doing. Happy to be here.
We've talked a little bit. One time, I think you hopped on a Spaces. Maybe there's an episode. I think we recorded it out there, but it was like a panel of people. And afterwards, I was like, man, we got to get you on for a full episode. You guys are doing a bunch of interesting research. And for those that don't know who you are, we'd love to just tell a little bit about yourself and your company and what all you guys are up to.
Yeah, so the best way to classify us, we do lots of things, but we're a social media first asset manager. So we have a public fund. The ticker's DARP, Disruption at a Reasonable Price. If you want to go check that out, you can read more about what the strategy is. We also publish research across the spectrum. We're always looking for growth industries and new sectors and new trends. So we cover a lot of growth industries, a lot of technology, but our backgrounds are also in commodities. So that's why we're going to be talking a lot about commodities today. We sometimes dive back into that world, and we've recently been looking at uranium, and we're big bulls on natural gas and other things. So that kind of sums up what Grizzle's all about.
That's great. Real quick, let's touch on the social media first part. You guys do a great job. I mean, you put out content. You've got a number of good, I guess, social media personalities, or really just employees, I guess, but people that are out there with a following, making content. Just a little bit about how you took that angle. What made you say, hey, this is how we need to lean in, use this tech and use these types of platforms to enhance what we're doing?
That's a great question, actually. So we started on the buy side as investors. The old banks up in the top floor, it's really quiet, nice and boring. It's like a temple. And we realized this feels way too good to be true. This can't last. And so we were just looking at social media and seeing the power of Twitter specifically for investing, and just how many smart people are out there and how cheap it is with social media to reach a large number of investors. So we just wanted to do something different and get ahead of the curve and start building that social following. So, open sourcing the research that we're doing, we think that'll be valuable to people. And then as our following grows and people start to trust what we do, then maybe they would consider letting us manage some of their money. So we're kind of in that stage of getting our name out there, see the work we do. If you think it's good, then maybe you take a look at some of our other products.
Man, I feel that resonates a lot with me. I mean, my story was a couple of years ago. I've been in the entrepreneurial space for a while and have a service business. So like my target audience is kind of like oil and gas producers. It's not like this really broad audience. And so I didn't really ever see like a huge benefit to getting on social media. In fact, I was pretty dark up until about 2020, or 2021. So I guess it's been almost 3 years now, and it's huge. And like you said, the marginal cost to reach that extra person, and maybe there's somebody that's going to be an investor one day. Maybe they're just somebody to network with. But what you guys are doing is smart, and it's a slow burn. People want to like get into social media and gain this giant following, but I think it's like what you guys are doing, which is putting out quality content. You're basically just giving a lot. And I think it's the people that are on here giving quality things, not just like outrage content or clickbait, but you guys are giving quality stuff. And so I just want to commend you, because it's a long game and it's a hard game, but man, I think it's the right strategy.
I definitely appreciate that. Yeah, it definitely is a long game. I think the one nice thing is you can't just come on tomorrow and game the system and grow really fast in this type of niche in investing. If it's, you can do clickbait for a while, but people realize they're not getting anywhere with that. So even though it's a long game, you build something that people can't catch up right away if you've been doing it for a while. So that's what we like to see.
Yeah, it's there's equity value there, and it's sticky. So let's get into it. Launching into the uranium side, just candidly, it's not something that I follow very closely. I see the chatter on Twitter I read guys like Doomberg and others, who I think you referenced in your recent report. And I've read a little bit about it. It's always been interesting to me. Don't follow the equity side of it. Don't really follow the fundamental side of it. Maybe just start with like kind of high level, maybe like a brief history of the uranium market. It's kind of a primer before we get into the details.
Sure. Yeah, I can just start with a little bit of macro. So, uranium goes through like pretty long cycles. It's a smaller market. If you look at all the uranium bought for nuclear reactors and you multiply it times the price, I don't have the actual like billions on hand, but it's, hundreds of billions. It's not that big compared to the total stock market, bond market, things like that. So, it's a more obscure market, but it's obviously very important. And so, typically in the past, I went through cycles where you have this buildup of inventory. That's the bear market, where the uranium buyers, they have more than enough inventory to run their nuclear reactors. So the price weakens. There's a bunch of explorers that go out of business because the price isn't enough to sustain their drilling. And then what happens is that inventories work down. Then it gets to a point where the buyer has to step in, and they get a little nervous when inventories get too low. Because if you look at the cost of running a reactor, the fuel is a very small part. It's below 20%. So they don't really care what they're paying. If they have to pay
Mm.
$50 a ton or 100, doesn't really make a difference. But what does make a difference is if they can't get any supply and they can't run their reactor. That's a big problem. So that's why you see these spikes in prices when inventory gets low. The nuclear reactor buyers, they get a little nervous and they just say, I need to refill. I don't care what the price is. You see a big jump. And obviously, this is a commodity business. So you get all these new explorers coming in, want to take advantage of that price. You get a kind of bull market. Last bull market was 2007, 2003 to 2007, which we cover in our report. Now we're 2 to 3 years into another bull market, but we think there's a lot of room to run just looking at stock prices. And this isn't a typical cycle. It doesn't look like, because usually there's a set number of reactors. They're building some, they're decommissioning some, kind of steady state. But now the world is starting to realize the opportunity of nuclear. If we really want to hit our emissions targets, it really is the easiest way. And there's new technologies from Bill Gates and others that are much safer, smaller footprint that could change the game. So we're already in that normal destocking bull market. But if you get an actual step change in demand, new reactors being built, then it's a whole different ballgame. This isn't just a normal up and down cycle that can whipsaw you. It could actually have legs.
So, like, normally the demand is like relatively inelastic. You got a set number of reactors. They take a long time to build. It's fairly steady. They kind of know what they're going to need. But on the supply side, sounds like similar to, maybe conventional oil, where or like these offshore type mega projects. It's just, or any type of mining really too is a good proxy to this. It's just not like something you can flip a light switch and it comes online. I mean, is that a fair way to characterize it? Like, how long does it take when a bull market kicks in for a new deposit or new explorers to go out there and really make it happen?
So there's a nuance. It does take a long time, but it's not necessarily because it's so hard like an offshore drilling rig. It's permitting because you're dealing with nuclear fuel, and it can be dangerous if you just walk up on a nuclear fuel depot. So the permitting is the big sticking point. And so I think, if you have a mine that was permitted in the past, you can maybe get it going in 2 to 3 years. But if you're starting from scratch, you could be 5 years plus. So that's kind of what we're looking at. And then we also have the nuance of the market. For a while, the cheapest supply was coming from Russia and Kazakhstan, and they take the mined uranium and they process it. So they were the big processors too. But obviously, there's a risk to just doing business with Russia. So we used to have production in North America, in the U.S. U.S. has fallen to nothing. So we're in this weird situation where there's lots of reactors in the U.S. that need lots of fuel. They import it all. So that's another catalyst for North America in particular. If these reactor guys are starting to get nervous that, will Russia always be there? Is there going to be sanctions? Will they stop sending fuel to the West? Well, I want some supply in America. There's some in Canada already. Then you get a big change because you go from literally zero demand to it could be a lot of demand and no supply in America.
It's interesting because this is similar to like anything in the energy transition space. There's just a lot of heavy mining, heavy industry involved, and the U.S. has clearly fallen out of that space in a big way, not just for uranium but for other mining products as well. it's like it's kind of wild to me that we're moving to this future where people are wanting, or at least the popular public and politicians are wanting, this lower carbon energy sources. Yet we need a lot of mining to get there. And I just, do you think it's gonna is the U.S. capable to bring on new supply of mining, or is this something that we're gonna have to push it like Canada and others, or people outside of the U.S. that can go get these new deposits?
Well, uranium in particular, I think it can happen. There's people that are in the industry that have mines that maybe produced back in the last bull market shut down because of economics, so they're
Mm,
ready to go, and so you can bring that on. It's just when the permitting will come through. So that is the X factor, is the permitting. Like it seems like these companies that I follow, they're moving through the permitting process, so they're not just being held up by the government saying no new uranium anything. They do, for security reasons, they probably want some supply. The question is just the timing, and is enough supply able to come on through permitting to meet whatever happens to demand down the road if Russia and Kazakhstan aren't always there for us.
So after the last bull market, prior to the recent one, there was, I'm guessing, essentially just curtailments in the mining space, mines shutting down because the economics didn't make sense. How hard is it from a storage perspective? I mean, obviously, oil is very, you got to store it, and there's a cost there. Other commodities like natural gas, you got to store it underground. I mean, but for uranium, like, did they just have stockpiles? Was it easy to store? And then they just, as they work those off, they realize, oh, we're going to run short. Or just walk me through like that supply cycle through the last bull market, and then what's kind of spurring this new one.
Yeah, as far as cost, I don't think it's that expensive. You either just leave it in the ground. So there's two types of production. You can mine it, you just go underground and dig it up, or you can do in situ, which is what heavy oil in Canada. You pump some liquids down into the ground. You drill wells first, pump some liquids down. You get uranium back up in a liquid form, then you
Hmm.
process it. So they just would turn that off. And you also have some stockpiles that you think of if you mine some copper, but you don't run it through your processing facility. You just have a pile of tailings, as they call it. It's kind of like that. So the cost isn't that prohibitive. It's really just the permitting and refurbishing the all the stuff that's been sitting around collecting dust for 10 years. You got to go through that process.
That's interesting. What about the scarcity of these deposits? I'm not real familiar. And again, these are probably pretty elementary questions, but is it one of those things where you've got it everywhere? There's really only certain areas where you can get it. Like, how scarce is it to find these deposits? I mean, permitting aside, saying that we could just, the government or whoever green lights it, like, is that going to make that much of a difference, or just how rare is it to find these deposits?
Based on what I've seen, it doesn't seem like deposits are going to be the sticking point of can we find enough. Because of that last bull market, everyone was exploring. Then
Mm,
it ended up being too much supply. So there's a lot of uranium they found underground. They haven't dug it up yet, basically.
gotcha.
The best place for uranium is the Athabasca Basin up in Canada. There's you can find uranium deposits that are like 30% uranium, and in the
Wow.
US there'll be some high grades, but high grade is like 5% or something like that. So they know of a lot of uranium up in the Athabasca, and if prices were high enough, they could just start drilling that out and have a lot of supplies. So I don't think exploration is going to be the sticking point this time around.
Gotcha. Well, we've talked about the supply side on the fundamentals, the demand side. Nuclear has in the U.S. kind of stalled out. There's now this resurgence you've seen in other countries around the world too. In Europe, it stalled out for a while, though you're seeing a lot of hype about new reactors getting, either commissioned or people wanting to put new reactors in. They're getting approved. China's been putting in a number of new reactors. I'm just wondering, is this hype as real? I mean, how do we dig through the noise? Because like I follow some nuclear people on Twitter, and if you just went by their tweets, it's like, oh my God, we're going through this brand new nuclear renaissance, and I think that's great. But I'm just wondering, how much of that hype is real? What's the risk on the timing of these things? You get one in the U.S. like the one in Georgia, and it's dragged on forever. I mean, how do we forecast supply, or I mean demand, for these new reactors? And what is your take on just the macro shift of, is it real or not that this new wave is coming?
Yeah, I'm a pragmatist, so I never I try to look at the negative information and the positive and then come to a conclusion there. So I try not to get too swayed one way or another. I think a good way to look at it is I don't think we've confirmed that it's a renaissance in uranium. What will really drive the new future of nuclear is we're seeing like the cracks in the armor of since Chernobyl and since Fukushima, the public globally kind of pulled back from nuclear. If you look at opinion polls, they got more nervous. You still see those like Chernobyl on HBO, great series, but that's scary stuff. Even though the number of people that ended up dying from that are very small, and there was a nuclear meltdown in the US that everyone hears about, 3 Mile Island. I looked into it recently. No one died from it. But you never know that because it just sounds like it's a nuclear meltdown. So the safety is better than you think. But if you look at recent opinion polls, they're starting to thaw. People are agreeing that maybe nuclear has a place. And if we can bring on those new technologies that are even safer, smaller footprint, so you don't have these massive facilities that take 20 years to build, some of them, then it kind of changes the game. And I think it's going to take till really the first one of those small modular reactors, they're called, isn't starting till 2028. So if we get that starting up, runs fine, that could start changing public opinion. But right now, this is more a bull market of China, Egypt, Russia, Turkey, India. They're building a lot of reactors. And permitting is not a problem there. Like if the government wants them built, they get built. So they're moving full speed. And just those reactors that are already being built are forecast to cause shortages in uranium. So that's why everyone's so excited. You don't really need to use hyperbole about a renaissance to think that the
Sure.
stocks go higher.
Yeah, absolutely. What about the financial side? You mentioned your report, like something like, I think you said 30% now by some of these, I guess, trusts or funds that are set up to buy uranium, and I guess in the physical market. Just talk a little bit about that and what impact that's having.
Yeah, that is a game changer actually, because we've never had that in uranium. It's not a big market. So there's these financial vehicles now that buy uranium, the Sprott Physical Uranium Trust. It'll just buy uranium and it gives you exposure. If you want exposure to uranium directly instead of a miner, that's how you can get it now. So it serves a purpose. We have that in gold, we have that in oil. But the thing is, it doesn't take a lot of flows and buying from that trust to be a big part of demand. I think when I just looked at when they first launched that fund and they were buying the most uranium they were in a 6 month period, they were on pace to be 25% or 30% of all global demand for uranium. So you could run into a weird situation where if the bull market gets too heated and everyone says, well, I want to be in the uranium trust, get exposure to uranium, too much money floods in, they buy more uranium, drive supply down, and inventories down, prices go up, the whole thing goes. You could see regulators or the government step in and say, hey, you can't keep buying this. You're basically cornering the uranium market.
Yeah, I feel like it could cut the other way too, right? If like people want to start taking those wins, I mean, could they potentially dump it on the market as well? I mean, is that like a risk, or do they even have anybody to dump it to? I mean, I guess that's where I'm scratching my head. It's like if you buy, physical uranium, yet there's only so many other buyers that are actually these, reactors that need it, and they have a schedule where they buy it on. How do they sell if you if you have 30% or some huge portion of the market? What happens then if they need to dump it?
Yeah, that'll be a good to go down the rabbit hole because I don't know exactly where it's stored. My assumption is they're buying it all from someone who has inventory and they're not taking delivery.
Hmm.
So the
Yeah.
inventory is still sitting at those different places. It comes down to does Sprott have the relationships with nuclear buyers where quickly, they could get rid of all of that excess inventory. But that is a good point. It basically it could increase volatility because you just have more financial buying, makes the market tighter than it would have been. Prices go higher. Then down the road, they try to sell that inventory when there's already a glut, for example. So that's a good point.
Yeah. It's interesting. Well, it's not something I really thought a lot through, but when I read that, that was my thought was, well, this is kind of this weird demand side equation. And these guys are increasing that demand artificially, but what other like ripple effects could that have? I don't know the answer, but it's just, I'm curious about how that could play out. Something to watch. Talk about now, because we've talked about the fundamentals, but I know you guys are heavy on the equity space. And how do you see it? How's it playing out currently? How's it played out in the past with these equities? And then we'll get into the details around small and large cap and some of the different things that you guys are paying attention to.
Yeah, so this is the really interesting thing. Because this is a smaller market, there's not a lot of names. It does make it maybe easier to find certain trends. And the market dynamics haven't shifted a lot from the last cycle to now. So you could kind of say, with some degree of certainty, we think past history may repeat. And so what we kind of looked at is, when do the stocks run? How high can they run? And are there different performance indicators depending on who you own? Should you just own the whole industry? Should you own the bellwether, which is Cameco, they're the largest producer? Should you own just the explorers? We kind of went and looked at what worked. And number one, when these things move, they move a lot. I mean, it's not uncommon for things to be up 10x. I know in Twitter at one point during COVID, everyone loved talking about searching for 10x, 10 bagger stocks. Those days are long gone. But with these stocks, some of them already have delivered 10x returns from the bottom in 2020. That was March 2020 when the whole stock market was going down. That's kind of the beginning of the uranium bull market. So to give you an example, in 03 to 07, which was when the bull market in uranium ended last time, the bellwether Cameco ended up going up 800%. Great return. But if you had bought the bottom 50%, basically the small caps, they went up about 1,200%. So they outperformed. Now, if you fast forward to today, Cameco's already up a lot. It's now 550%. So it's getting close to that 800. But the small caps have been lagging a lot. They're only up about 150%. So that's where we're saying, well, it looks like this bull market is still in the early phases, and we're seeing a little bit of the catch up in the small caps. They're starting to outperform Cameco, which they haven't up until now. So what we did in our report is try to dig in and say, specifically, let's use some qualitative data to differentiate just buy all the small caps, because there's some junk in there. Let's find exactly who may be the best performers, because if you had picked the best group, not just all the small caps in the last bull market, your stocks went up 3,000% instead of 1,200%. So it's a big difference.
That's interesting. What about, are these just miners, exploration guys? Are there processors? I mean, I'm just, again, so ignorant on the different segments of the space. I know energy, but is it transportation? Are there marketing? I mean, what are or is it just basically the guys producing it?
There's only a few producers. There's maybe 6 in the whole industry, which is funny. So most of these, if you're talking about small caps, they're either moving towards building a mine, they have a resource, or some of them are just exploring. So they're saying, we've drilled some holes, we found 3% uranium in the targets, but they don't even have a resource. So that's where the nuance comes in. The reason we think that there was that subset that outperformed by so much is because eventually institutional investors come in when when they're comfortable enough with the macro backdrop. And that's a lot of money chasing not much market cap. I mean, the largest one, Cameco, is like $18 billion. And then there's not many companies above 2. That's pretty small market cap. So a little bit institutional money can move the stocks a lot. What they're looking for is they want some resource. Institutional guys aren't all uranium experts, so they're not comfortable looking at an explorer and saying, I'm going to figure out what the resource is from these intercepts they're giving me. They wait for the company to report a resource, and then they want to see that the resource is increasing over time. So what we think drove this is, you want to buy the guys with some resource and the ones that are basically increasing it. And then we added an overlay on that of have they grown their market cap faster than the dilution from issuing shares? And what are insiders up to? Are they buying and selling? And then also valuation.
So is it similar? One proxy I have around the buy side research is kind of oil and gas stocks. And I think that over time there's less coverage. Part of it has to do with just how bad they performed there the last decade. And I talked to guys like David Heikkinen, who used to come on the podcast quite a bit, and he's saying that the number of analysts covering these stocks is down, which means in some ways maybe there's
I was one of them. I'm not doing it anymore.
Yeah, there you go. So I mean, did that happen with uranium after the last bull market? How well is it covered? And if it's not covered that well, does that present more opportunities?
Yeah. I think that happens with any sector. You saw even with like the rare earth bubble, which I lived through in, I think it was 2011 or so. When the stocks are working and fundraising is going up, a lot more coverage comes. So you're starting to see that a little bit with the fundraising is picking up, especially in the small caps. There's more analysts starting to cover the space. but it's not many people. It's still an esoteric market. So I think as the longer the stocks do well, you're going to see more analyst coverage, and it will kind of feed on itself. Because I know now we're starting to see some articles in, say, the Wall Street Journal on uranium, when before it was just all of us in uranium Twitter land kind of patting each other on the back for how it's been doing.
Yeah, for sure. Is it like, and again, similar to the energy side, is it where is the juice worth the squeeze going after these smaller names and trying to pick the winners? Are there good funds or ETFs or other ways to play it broadly? Are you better off just buying the blue chip? Do you just go to the physical trust, or what are your thoughts about how to play it?
So after investing in commodities for so long, I think playing the catch up trade is a legitimate strategy. It doesn't work often in secular growth industries like tech, for example. But when you have a bull market in a certain commodity, the best stocks that are, because there's fundamental analysts that would know the best stock, it's also the most liquid, easy to get into. Those go first. That's what we're seeing with Cameco, the largest company. But then eventually, everyone just gets so excited. They think, well, wow, if prices are this high, imagine what this little guy exploring can be worth. He's only worth 10 million. If he finds what I think he'll find, he can sell that for 100 million. That type of thinking comes in. So obviously the market gets too overheated and too bombed out. That's the opportunity. And so I think we're now at the opportunity where people are starting to get really excited about the potential of uranium, and the small guys haven't really moved. So that's where you'd want to be if I was putting money to work in uranium now, not the bellwether, because you're playing for upside. You're not trying to be cautious at this stage if you're in uranium at all.
Right. Well, it's like a lot of these small caps in the oil and gas space. You get seduced into finding that 10 bagger, like you mentioned earlier. You want to get in and hope that those reserves are real, and that and that you can ride that wave. That's good stuff, man. I think that's about as in depth on question wise as I can go on uranium, given my limited knowledge. But I feel like I've
Yeah,
learned a
that was
lot.
pretty good. We spent a bit of time on that.
Yeah, I wanted to. I don't cover it and very much, and I feel like now, even after this back and forth exchange, I've got more ammo to come up with more questions if I do something in the future on it. But want to pivot to just my kind of the stuff that I know really well. And you mentioned you're a natural gas bull. I love hearing that. My company, we've got exposure to the physical natural gas prices, and I've always kind of lived in this world through the good times, like last year, and then through this year, which has been soft. It's just this up and down roller coaster. I can make a case in a lot of different ways for natural gas. I'm always wrong typically, but would love to hear a bull case for it, and then would love to talk about some of the fundamentals you guys are seeing, LNG, et cetera. But I'll let you kind of open riff on it first, and then we'll get to the details.
Yeah, so I've published a bunch of research on Twitter and our websites and everything on LNG. It's one of gas in general. It's one of our core holdings in our fund because we just think that it's misunderstood and people will come around. The opportunity here is really LNG. I don't think you can talk about natural gas specifically in North America without LNG. So I'm going to talk about the medium term, basically the next 5 years. That's where I have the most confidence in what's going on. Longer term, it's harder because I saw some really great data that looks at natural gas over a long period of time. The price has basically been kind of flat versus you look at oil, it goes up with inflation. We've had higher oil prices over time. So what that tells you is that there's a lot of gas. Also, the gas has been gaining market share, but that there's not a supply problem. So that's why prices have stayed flat. But I think there could be a supply demand mismatch in the next 5 years that's driven by LNG. So I'll give you some of the numbers here. The cheapest source of gas for LNG facilities outside of Qatar is the US. We have a ton of gas from shale drilling. So when I just look at, if I'm a buyer of LNG, where am I going to go? I want to get the cheapest LNG I can. So US is really the place to play. Canada kind of fumbled their opportunity. They have just as cheap gas. The permitting's been a nightmare. I looked back 10 years ago, they had as many permits for projects as the US did. There's not one up now. We've built like 5 since then. So it's just the benefit of the US. Stuff seems to get done a little easier and quicker. But so what's happening is there's a big flood of LNG projects starting up basically mid next year. Then for the next 2 years after, there's a flood of LNG in the US coming on. And I think it's going to really tighten the North American gas market. To give you perspective, gas demand in the US generally grows around 1% just from like normal demand. We're using more electricity, there's some electric vehicles driving around. But with this LNG alone, it could bump that up to 3 to 3.5% growth. And historically, when LNG facilities have come on, we do get a bump up in gas. So I think that not only will we get a bump higher, and the stocks are already cheap, where some of them are paying good dividends on a free cash flow basis. They're generating like 15%, 20% free cash flow margins. That's going to stay where it is, allowing them to pay out even more to us. You're also you're going to get higher and more sustained natural gas prices, is basically our view. And the other opportunity is we think the industry is going to come around in the world to, if you want to decrease emissions, you can do it with nuclear, but that takes 10 or 20 years. Or you can just build a gas plant, is the most pragmatic way to do it. Get rid of a coal plant and an oil plant, build a gas plant. You've cut your emissions in half, and you don't have the uncertainty of supply from renewables, which, we could talk about.
Yeah. Well, I think your point around the deflationary nature of natural gas specifically, I mean, if you look at it on an inflation adjusted basis, it's ridiculous what the price is today, especially if you look at like in basin prices for some of these plays here in the US. And I think it's as much of a technology story. I mean, obviously the supply is there, but the supply is driven by technology. When you look at energy technology, the horizontal drilling and hydraulic fracturing is the real deal. And the reason why we know it's the real deal is because the price of these commodities and what it's done to them over time. And that's just, it's crazy. And so that to me is like kind of a litmus test for energy tech in general. It's like, if it's, causing the price of the energy to come down over time on an inflation adjusted basis, then we know it's a valid technology versus, like you mentioned, renewables and some of these others, which I think are hyped as having this kind of Moore's law or whatever. But I don't know. I think natural gas has played the part well. What do you think about the global market for LNG? I know we can build it here, but this last year has been such a whipsaw around, oh my God, look at these spreads, look at the prices in Europe, to then things collapsing and people rumblings. They didn't really take off, but there were some rumblings of like, hey, there could be LNG curtailments because the demand's not there. I mean, I know we can build the facilities. We're doing a good job of that. I know we have the supply, but can the world soak it up, given what we can produce?
Yeah. So the good thing is most of those US facilities, they don't get built. Nowadays it's changing, but in the past it wasn't built without long-term contracts. So they're locked in, and 80, 90% of their supply has already been accounted for. It's going to be bought. And you also have, on the demand side, Russia kind of changed the game last year. That's why gas went from 250 to 9, which was insane to think we had $9 gas at one point.
Yeah.
But you have Russia, one of the largest suppliers of natural gas to Europe. Now Europe's starting to realize that's a huge liability. We're going to have to move away over time. They backtracked a little bit. It sounds like this winter, Germany may be taking some gas from Russia, even though there's technically sanctions, which is kind of a joke on its own. But eventually it's moving that way away from Russia. So there's this huge chunk of supply that's going to go away. And the Western world is already leaning on the US. You're seeing Europe sign a lot of new contracts with the US. Granted, it looks from all the good research I'm seeing that this winter is not going to be a problem. It's not going to be like last winter where they're running out of fuel. They've just cut their use too much of energy and their inventory is too high. So we're not going to get another spike. But the more you see new LNG import facilities get built in Europe, which they are, and the contracts get signed, that gives me confidence that there's extra demand there to soak up all that US supply, because Russia's basically being replaced.
Right. Well, and you wonder, even with these long-term contracts, could there be a situation where physically, if for whatever reason, warm winter, whatever it may be, sometimes even if there's a take or pay or they have a commitment, it's like, well, it might be cheaper to just pay and not take it. I don't know. I mean, I think there were some worries about that. All these ships, all these cargoes kind of bunching up there in Europe. But I think that was sort of the exuberance of, hey, these prices are so high. And then also the demand. Everybody was scared of this terrible winter and the energy crisis that was developing. And so we'll see. I mean, I think that's, it's obviously bullish for demand increasing, but on the supply side, you talked about the equities, the US E&Ps that produce a lot of natural gas. There's some headwinds there. I think economic headwinds, it, kind of prices under 250 Certainly in basin, some of these basins prices in the dollar range still once you take out differentials, and then that's just the price they're getting paid, and then they've got all this transport and gathering fees, et cetera. And so, do the netbacks at the wellhead support robust supply growth in regions like the Northeast? Obviously, you got the associated gas from the Permian, and that is almost like totally disconnected from the drilling economics, right? Because it's just a byproduct, basically. But when you look at these LNG contracts, I mean, the part that's staggering to me is that like they're long-term agreements and it's a lot of feedstock that's needed. Who's going to step up to bring that to the table? Which basins are going to step up? We're getting into like tier 2, tier 3 in the Haynesville. It's still prolific, but just your thoughts on supply, where it's going to come from. Can we meet this increasing demand? Not over 5 years, but these are long-term contracts. You're talking 10 years, 20-year deals.
Yeah, no, it's a very good point. I mean, that's part of why we're bullish, because LNG, it just uses a lot of gas, and then on top of that, you have shale. Some of the good research that I've read looks like shale, some of these peak shale basins, production could have peaked. Like we've been saying that for 10 years, but some of the underlying data on the wells, there's been a lot of changes going on where the fracking technology has continued to improve. Now it's more in a steady state, so you can kind of differentiate. You're drilling a longer well versus is the well getting worse. They're starting to think that the Permian, the most prolific basin in North America, may be starting to peak, so that if you have less oil drilling, you have less associated gas, because for anyone who doesn't know, gas comes out of the oil well as well. And then you also have the gas drilling. So I think, the industry has been really good in the US, especially with fracking, finding the gas. But I think it just speaks to this amount of new demand needs higher prices. I don't need it to go to the moon. If I have $4 gas instead of $2.50, I'm still happy based on the valuations of a lot of the names. I think in general, I'd caution you want to be in the right zip code, because you need to be producing where the demand wants your gas. Otherwise, you're kind of out of luck. So we like to own the guys that are near the Gulf Coast, which is where all the LNG facilities are being built, or people with low cost gas in the Haynesville, as you mentioned, but they have pipelines to the Gulf Coast, that type of thing.
Right. Well, and I think the Permian story is interesting. The inventory question mark. I've talked to a lot of smart folks and people that have spent a bunch of money on research, and I think it's kind of like realistically 6-7 years of like pretty confident, and that could be stretched out or compressed depending on development, pace of development. And then, past that, it's sort of like, you could see some, and it may be one of those things where you don't see as high of a peak on oil production. It's smoothed out, and then that gives you more, right? Because it's the pace of development, and prices play into that as well. But it's certainly not forever. I think like we get into I say we, just the Twitter community, or the people that the echo chamber that you're in, thinking that this stuff is forever. But like, 6-7 years goes by pretty quick. I mean, 5 years, shoot, we're coming up on 4 years past COVID. It seems like it was just the other day. I mean, like, when I look at my career, I'm like, man, 6 or 7 years isn't that long a time frame. And then you look at like some of these other gas basins, like the Northeast. Do you have any thoughts on like these infrastructure constraints? I guess that's your point earlier around owning it close to where the demand is going to be, because there's real question marks there around, can we even get it out of some of these basins if the regulatory, regime in charge isn't going to greenlight things?
Yeah, I mean, I was deep in covering this industry through the shale revolution. I covered it as my full-time job, 2010 to 2018. And so I remember there were basins, because supply was growing so fast, because shale was just revolutionizing the US. They kept finding new basins. There weren't enough pipelines. And you see what happens. The pipes would eventually get built, but there'd be huge discounts that these guys would have to offer to just find someone to buy, because you'd have to say, truck the oil or put it on a train. They were spending millions up in the Bakken in North Dakota, to move the oil around on trains, because they didn't have the pipelines. So that's, again, like, it looks like the production will get sold. Some people did have to shut in, but it wasn't a huge problem. But the thing is, you might have to offer your oil at a $20 discount versus the next guy. As an investor, why do I want to own you then? So that's why, if you're close and you have the infrastructure in place, you just mitigate that risk.
Right. Well, in gas, you see it. I mean, like I mentioned, just the in-basin differentials are sometimes brutal. But then like you tack on all these other fees, and it's not like that's why I always try to get really bullish on gas because I look at it and I'm like, there's just no way they can justify drilling at these prices with these gas differentials and then all the fees stacked on it. And I'm typically proven wrong, whether it's like the associated gas story that you miss, that comes on way more than you thought, or whether it was all the disconnection there during the shale revolution between guys that had debt that had to service it. They had other motivations basically for drilling outside
Yeah,
of just
they were having losses funded by Wall Street, so they could lose money for longer than we expected.
absolutely. And so those are the things you don't think about. And then I think last year, what was interesting was, prices spike and everyone's like, oh, they're going to be disciplined this time. And then you see some few guys go gangbusters and bring more supply on than we thought. So I want to believe, Scott, I want to believe in the 350 to 450 thesis. I think that's a healthy range, quite honestly.
Yeah, that's why I have a medium term view, not a long term view, right? Because
Yeah.
if there's a 2 year period where everyone says like LNG demand is far exceeding supply, I like my chances there better than making some big call on overall we're going to start producing less gas because it just hasn't happened in decades. So
Yeah.
I don't know if that's going to change.
Yeah, I think that's a good view. Pivoting away from gas to the oil side, oil bulls are happy right now. I mean, as of this recording, I haven't checked it today. I think we're in the 90 something dollar range a barrel, and there's people clamoring. Reports saying $150 a barrel. There's people saying, don't fight the Fed. Look at the yield curve. The recession's coming. Oil's going to go to $60 a barrel. Just your thoughts on where we are today, just thoughts about kind of scenarios that could play out in the oil space here over the next kind of short and medium term.
And with oil, I think that's saying it was the best of times, the worst of times kind of applies to oil right now because you have prices almost close to triple digits. But if you look historically what that means from where we are in the economic cycle and kind of what comes next for stocks, it typically isn't that great.
Right.
So oil is outperforming other sectors. That typically only happens at the beginning of economic cycles and at the end. I think we can all agree we're not at the beginning of an economic cycle with some of the headwinds we're looking at with the Federal Reserve policy and other issues. And so this is one of these things where you want to be cautious. And I think if you look at the stocks, they already are. Typically, you don't get the full credit for where prices are. And that disconnect is starting to widen where the stocks haven't really been moving along with the commodity. You would have been better off just owning oil in the last 6 months instead of the stocks. So it just puts more pressure where we are today on inflation. And obviously, that's a problem because then if the Federal Reserve keeps rates higher, that puts pressure on the value of stocks. Now, we were talking with Warren Pies, who is a really smart guy on oil. He made a call that oil would go up the last 6 months, got it 100% bang on. He's a good guy to talk to. And he was trying to explain why oil isn't really able to discount the future like a stock. A company, you'll say, well, I think next year will be like this, and that's kind of priced into the stock. Oil just works on what is supply and demand right now. Yes, there's a futures curve, but think about like, are they really pricing in the chance that demand falls 5%? It's really based off of that where demand is now. It's kind of a today weighing mechanism for oil. So he thought that's why you see these periods where even though there's all these like economic headwinds and growth headwinds, oil's still doing great because the consumer is still holding up. They're spending. Demand is still better than expected. And so prices should be high because demand's still high. Even if, say, there's a cliff coming, if we knew in hindsight that the consumer is going to really pull back, stop driving, demand's going to fall 3% like it did in '08. Well, that's obviously not being priced in if we're at $100 oil. So I would just caution people like, this is great. There's definitely some supply issues. OPEC is cutting as demand has held up much better than people expected. But typically, you see this type of move, and then the other sectors, lagging near the end of a cycle, and there's risks to demand in that situation.
Yeah. Well, I don't think OPEC wants it to go to $150 a barrel. I think that they are happy. I would think they would be happy in this kind of 80 to 110 maybe range. Maybe that's even too wide of a range. I don't know how high, at some point, clearly it's a finite resource. The game theory around OPEC, during the shale revolution is they wanted market share and they wanted to kind of break the U.S. industry, which in a lot of ways they've sort of succeeded, given now our more measured pace of growth. But I don't know that it benefits them to push the global economy into a massive recession with $150 oil, and then it whipsaw and this a bunch of volatility. That being said, I also don't think that they're going to want it to go to 50 or $60. So it seems to me maybe like the floor is higher now with OPEC kind of being more in the driver's seat on these incremental barrels. Is that a fair assumption? Even if we did have a recession, they'd maybe do more cuts, is I guess my point.
Yeah, yeah. I mean, I think OPEC's power has kind of come back. There was that 10-year period where shale did the world a favor. We got cheap energy for 10 years because shale there was so much new oil. It got exported, so much new gas. It started to be exported. But now, because we're seeing shale isn't as prolific as it once was and it's not growing so fast, OPEC now has more power and these cuts actually matter. I think you're spot on. I heard Saudi Arabia, maybe their break even rate, is 85, 90, something like that. So they'd want it around there. They're fine. Obviously, if it goes too high, you get demand destruction. That means people either, if they have a machine that runs on a gallon of gas, they'll, change the insides of the machine where now it uses less than a gallon of gas. That means that it's never going back to using a gallon of gas. You don't want demand destruction because that just means there's less demand down the road for oil. I would mention in economic downturns where consumers are using less energy, industries using less energy, OPEC's cutting, but the demand has a bigger impact because it's falling. So they're kind of just balancing it out. That's why you get the bounce back in prices. But they've never historically been able to cut enough that prices don't go down at all. When stocks are going down.
Right. Well, and I mean, there's this thing too with like lower oil prices and the consumer behavior. I think in the short term, it felt like, I mean, I remember when oil got really high there for a while, kind of early in my career, in that $100 plus range, like the price of gas was a big deal. It seemed like there was more people, especially in my bubble in Oklahoma City. And I worked at Chesapeake, and it was like the CNG stuff was really gaining some momentum. A lot of that was, Aubrey and others pushing it, but people were really getting more conscious around the miles per gallon for their vehicle. And I saw a lot of people driving Honda Civics. And then this last decade, it seems like, you get kind of lulled into this cheaper oil price environment, and you see a lot of SUVs and trucks on the road.
The Hummers are back.
Yeah, right. So consumers kind of like in the near term maybe use less, but then they get kind of conditioned, and they, it's like when things are cheaper, you want to buy more of it in a lot of ways. So it's almost like it'll balance. I just have a hard time seeing, for me, oil is a much clearer path to a sustained higher price, given what's going on in shale, given what's going on with OPEC. And I think this peak oil thesis is overplayed. I mean, what's your guys' view on the peak oil people out there? I mean, I don't know if you follow like Arjun from Super Spiked, but he's got some good takes on it. But just your thoughts on peak oil and where the demand side's going.
Yeah, Arjun was a colleague of mine. He was at Goldman, I think, for a long time, right? He made the original spike call triple digits in '08. Isn't that how he made his name?
I don't know. That's a good.
I think so. I
had him on the pod. Maybe he's just too humble to tell me that, but
he is a very humble guy. I'll definitely give him that. Yeah, he's very knows a lot about oil. So me and my partner Tom, actually, we did a big report for our company way back when. This is 2016 on the risk of peak oil from electric vehicles. And so we did all the numbers on growth. You can look at how fast EVs grow, how much will that displace oil. And it really just looked like all this is going to take longer. Like there still could be a peak of oil, but it's obviously going to take longer than people thought. We didn't think it would happen before 2030. Everyone, was saying, could it be 2025? This is back in 2017. Obviously now it's more like 2030, 2040. So I don't think it's something we have to worry about. There's going to be another cycle at least before. But if you continue to have this growth in electric vehicles where they're being subsidized, the batteries the energy density of the batteries goes up. That's the most important. So the range anxiety goes away. Then you do start to get, that gasoline demand falls off, and it could lead to a kind of a peaking in oil, but that's going to take time to play out. And we need some other things to work, like people buying EVs still are early adopters. You need it to get to the price point and the range and charging infrastructure where someone who has the Honda Civic is willing to upgrade to a nice Tesla or something.
Yeah, yeah, for sure. I think it's well, I can talk a lot about EVs and the quote unquote energy transition. They're interesting. There's a set of the consumer market that wants them, that likes them. It just seems like they're not there yet. Kind of the long and short of it. There's a lot of people that
Yeah.
they're just not going to work for. You mentioned in our notes prior to the pod around underinvestment in commodities in general, potential for maybe more energy crisis type scenarios. We've covered a lot of this stuff, but just your thoughts and this broader theme. Do we get back to a place like it was in Europe last year? Was that just the geopolitics of it? I mean, is it realistic that it could go there, or is that too much?
Yeah, this is a great topic because it's one that makes me really nervous. And I'm typically not, I'm not a gold bug. I'm not like a doomsayer or anything like that. I like take things practically. But the more I'm seeing this, I'm seeing a trend throughout commodities. And usually commodities don't have the same stories going on. Like oil will be oversupplied or undersupplied. It doesn't mean copper is going to be oversupplied or undersupplied at the same time. Some of these like base metals will move together, but oil and gas are usually different. Uranium's different. But every commodity market I look at, you're at this period where there's just not enough investment and demand for all these things continues to go up. So I think we were in this period of la la land that's gone off for over a decade where you had very cheap funding. There was a lot of money in private markets, venture capital, startup. If you were a company trying to like start something new, you could easily get funded. And so there's been all these new technologies, the whole electric vehicle industry, it's using all these metals, copper, lithium, but you don't see the investment to ramp the supply to meet this demand. And then also, on natural gas and oil. So I think we may hit this reckoning where we've had this period where we're just used to so much excess energy. Grant shale was a big part of that because it just brought up a new cheap source of energy for 15 years. And now you'll have a reckoning where there's not enough reinvestment and prices, there's going to be shortages or prices have to go up a lot to incentivize new drilling. I'll give you an example that puts it in perspective why like all this building of renewables and shutting down of traditional sources of energy can be a problem. Say I have like a house and a business and it used to say like a terawatt of energy over a year, just a made up number. If I build a gas power plant or a coal power plant that produces 1 terawatt, I'm golden, right? I have my energy needs covered. If I build a solar panels or a windmill that it generates a terawatt, I have an energy crisis, right? Because they don't generate power all the time. So during the day, they're generating what I need, maybe even more, but then at night they're gone or vice versa. And so that's basically what we're doing. There's not enough battery storage, which you need to be able to provide this. So I just see the world, especially Europe, they're shutting down oil power plants, gas power plants, coal power plants, and they're building all these renewables that you can't rely on all the time. But you want to have energy all the time, right? I don't want my power going out at certain times a day. So there's a reckoning coming, and I don't. It's going to take time to play out, but it's closer than it was, a little while ago because it doesn't make any sense.
Everything you're saying in that example is just, it's in the back of my head. I'm thinking bullish natural gas. It's just such an easy fix to a lot of these things, right? I mean, it's like you want more renewables, great. It's going to cause a lot of problems. Here's a solution that can help solve a lot of those problems. And by the way, we have a ton of it. And, the US in particular is very well positioned to do it. So we don't have to rely on OPEC. We don't have to rely on Russia and these other actors. We can do it here domestically, and we can even supply the world in a lot of ways. So
You could build a gas plant in, less than 2 years. You could import the LNG for that gas. So LNG now has made it where gas is a world market. It used to be, you can't move gas around the world. So if I'm like in India, I could just close down a coal plant, build a gas plant, import the LNG. My emissions are down a lot, and
absolutely.
I have all the energy I need all day long.
Yeah, for sure. And I think like part of this near term pain, and I think where the Fed is in a bad spot is that the rising interest rates, and I mentioned this with a few guests in the past, it's like, inflation's hot, which means service costs are higher. And then you jack up interest rates, which means credit's more expensive. And when in theory, this is going to kill demand. Now, that's really the only tool the Fed has, right? They want to kill demand. But ultimately, like there's a whipsaw effect on supply too. Now, all of a sudden, these service companies, which they're already dealing with inflation, wages are going up. They got to pay people more. These guys live and die by lines of credit. They have incredibly tight cash conversion cycles. Now these lines of credit are way more expensive. Anybody with a heavy industry or heavy capex business, higher interest rates should make it harder to bring on more supply. I don't know if I'm overplaying that, but when I see rates going up, I'm like, this can't be helpful for the supply side of the equation.
No, that's a great point you make because we are seeing that because I look at oil, gas, as well as copper and all the precious metals. They're seeing lots of inflation. So that speaks to even if prices go higher, you would get the same supply out, right? Because you're just paying your contractors more. Your diamond drills cost more, all that stuff. So that speaks to even more trouble getting supply that we may need down the road. And there's actually a dirty little secret. I'm not against renewables. I want to decrease global warming, as much as the next guy. But costs of solar panels and windmills, have been falling for like 15 years. And that's part of what the industry points to. It's like, look at how exponential the cost decreases versus the price of oil goes up. But costs have actually gone up the last year or two because of that inflation you're talking about. But I haven't seen a new renewable cost chart come out from anyone because they don't want you to see that because that breaks the narrative of the costs are always falling all the time versus traditional sources of energy.
Yeah, absolutely. Well, it's again a heavy industry, high capex business, and it's really good for those types of businesses is when there's a lot of cheap energy. The shale revenue, it's like you want to say solar panels and these wind farms are getting cheaper. Well, we also a lot of things were cheap for the last. There was hardly any inflation, and it was like, oh, just by the way, that coincided with just a tsunami of cheap, abundant energy that was backstopping a lot of certainly the U.S. economy, but really being a tailwind for the world. And if that dries up, that and the combination of the cheap labor, out of some of these countries like China, I mean, at some point, cheap labor, they want wage increases. And so it's just to make things is becoming more expensive. So there's a lot there. We could go more, but we're getting short on time. Last thing, I've seen you mention a little bit about Bitcoin. I don't really follow the crypto space particular, but I do like Bitcoin. I've got our company's dabbled in the space. We got a little Bitcoin mine that we do. It's small, but I enjoy that space. And it's been a kind of a brutal last, year or so. Just any thoughts on what's going on in the Bitcoin space? And I'll tack gold on there as well. Just any thoughts on Bitcoin or gold? Because a lot of people look at them in similar lights.
Yeah, I'd say I'm no expert in crypto in general, but we have focused a little more in Bitcoin because people, hold it out there as it's a store of value. It's digital gold. It's the new gold. So I think we're at where the rubber meets the road, where if we get a downturn and we have these economic situations where that should be good for gold, well, it should be good for Bitcoin. So I'm very excited and curious to see how Bitcoin will perform because it hasn't been through a full economic cycle yet. So if it does perform like gold, well, then it really is digital gold. There's also a catalyst of, there's a bunch of vehicles, ETFs trying to get approved to own Bitcoin. So if that ends up getting through, if there's a new, SEC chairman replaced and he's more, he approves some of these things that were stuck in limbo, that could be a new source of buying, push Bitcoin up. But I think right now, it's kind of been tough for Bitcoin because the headlines with FTX going down and all the fraud in the industry definitely hasn't helped. Bitcoin has been holding up, but gold's been holding up a little better. So we'll see when the Fed starts cutting rates and gold really starts getting a bid, which usually it does. We would want to see Bitcoin right there with it to say that it is that new digital gold.
Yeah, I think I agree with all that. And I think that you're right about Bitcoin in the period of time that it's really been more in the mainstream. I mean, sure, it started in 2008, but it's been mostly on the backdrop of this lower interest rate environment and asset prices kind of pumping. We'll see. I think it's been, I've been pleasantly surprised, I guess, this year. I know it's pulled back some, but with just the onslaught of continual rate hikes, earlier this year it was on a tear, but then again, it was down to like 15,000 or whatever it went down to. And then it was all the way back up. It had doubled in price. But I mean, I think if it can hold steady in this range, when things change from the Fed perspective, it's probably got some room to run. I think the same for gold. Certainly with Bitcoin, it feels like there could be another big leg down, especially if there's like a a recession type event, or the looming credit event that everyone's talking about on Twitter. But man, it seems like just how mature the asset is. I feel like at some point it's going to pump again. I think there's a lot
Yeah.
of people out there that think the same way.
Yeah, I mean that's actually how what gold does. If you saw in '08 as a perfect example, when the stock market was crashing, bonds were crashing, everyone's nervous, everything goes down. So gold went down, but then you have this point where the cost of money is falling because the Fed is cutting rates to stimulate. That's really good for gold, and so gold then went to the moon, and so you probably get that again. So there's no way to avoid a drawdown in gold. Bitcoin probably would have a leg down if stocks are going down a lot, but if it works like it should as a store of value, if we have record budget deficits, which is very good for gold store of value assets, and then we have rates falling because the Fed is cutting to stimulate the economy again, should be great for gold, should be great for Bitcoin. So want to see that.
Well, we hit the hour mark, Scott. I really enjoyed it. I feel like we could go longer. What's a great place? What's a good place for people to find you and consume your work?
Yeah, I mean, on Twitter, you can just search Scott Willis. You can search Grizzle Media on Twitter. And then if you want to learn more about what we're buying in the fund, that's a public ETF. So you can see every day what we're buying and selling and what we're holding. Energy is a big piece of that. That's etf.grizzle.com.
All right, Scott. Appreciate it. Thanks for coming on.
All right. Thanks for having me, Max.